Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and lately the REIT sector has been very volatile, and this has led me to sell some of my positions to reinvest in some new opportunities, and in today's video I want to discuss two of them. Both of these companies have already surged by 10-15% since we initiated our investments, but they still remain very attractively priced, and I expect them to be some of my best performers in the coming years. But before I get into it, can you please do me a huge favor and click the like button? That helps me a lot to keep producing all this free content for you. Thanks so much for your support. So the first company I'm going to discuss here is called Caesars Entertainment. It's the biggest casino operator in the US. It's a company that I've followed for a long time because the biggest tenant of a REIT called YCHARTS Properties, in which we invest at high yield landlord. And it represents about 40% of its rental income. So it's been very important for me to monitor Caesars to make sure that it becomes in a good health to be able to pay up its rent to YCHARTS Properties. And as I've monitored it over the years, I've grown to like its business more and more. And so as its share price now crashed over the past 2 years, I became very interested to invest in it. And I finally did it recently when it hit $35 per share. Since then, it has already recovered to about $40, so it's up about 15%. But even then, it remains very attractively valued today. And a great way to put it is to look at its recent performance relative to the casino REITs, YCHARTS Properties and gaming and leisure properties. You'll see that there's been a very significant divergence in their share price performance. I'll put a chart on the screen with the casino REITs holding up surprisingly well, even as the share price of Caesars crashed down to historically low levels. And I think that this huge divergence in performance is an opportunity for investors. This massive underperformance seems to imply that Caesars is struggling, and if it was and it didn't even own real estate, then of course such a divergence could make a lot of sense, but this isn't the case here. Caesars is doing really well. We expect its cash flow to grow significantly in the coming years, and importantly to our thesis, it's not just leasing the casinos. Yes, it's leasing some of them, but it also owns a very vast portfolio of casino properties that it could sell in future sale and leaseback transactions to raise equity and reinvest in new growth opportunities. Okay, so I'm going to first discuss the business and its performance, then after that I'm going to discuss the real estate portfolio of Caesars, then its valuation and some key risk factors. So starting with the business, as I mentioned earlier, this is the biggest gaming company in the US. Many people know it for the Caesars Palace, but it owns many other brands including Harrah's, Horseshoe, Flamingo, and many others. I'll put an image on the screen with all the different brands, but the point here is that this is a very big and well-diversified gaming company. And it's important to note also that this company is not just about gaming. Its properties, its 50 properties have become real destinations for entertainment. They typically will include accommodation, dining, some shows, sport venues, some spas, pools, nightclubs, and anything else really. So people are not going there just to gamble these days. I'm sure you have some friends who or yourself have gone to Las Vegas, and you know that you go there, you might gamble a bit, but there are many other reasons why people go there. And so how they grow their cash flow is that they are improving their current properties, optimizing the operations. Secondly, they're also building some new casinos. And then thirdly, perhaps most interestingly to me at the moment, is that they're also building this digital gaming business, and they are able to leverage their casinos to have some significant competitive advantages. Last year, the company earned about $1 billion of free cash flow, and we expect this to grow very significantly in the coming years. It could close to double already in the near term in the coming years because of two key reasons. The first one is that we expect its capex to come down very significantly. Over the past years, the company has been building this big new casino in Gainesville, Virginia. The total cost of the project is about $650 million. Currently, it's not contributing any cash flow to the company yet. On the contrary, just costing it money. But this project is now nearly complete. And in addition to that, it has also been investing very heavily in its properties in Atlantic City to upgrade them. The cost has been about $800 million here, but soon this will be over, and so its capex will come down very significantly. Historically, the company has been able to target roughly 15% returns on such growth investments, and the management has a very good track record, and if that's what they achieve with these properties, it should grow its cash flow very significantly. Secondly, the company's digital business is now at an inflection point, and they've been investing very heavily into growing this business over the past few years, and now it finally turned profitable over the past quarter, only slightly so, but the management thinks that they will achieve about $500 million of EBITDA already in the near term, possibly even in 2025. And I really like this because I think that there are very significant synergies between the physical casinos and the digital app of Caesars, since the company has the biggest loyalty program in the casino space with tens of millions of people. And it's now able to offer these programs where people will gamble on the app. They will earn Caesars rewards points, which can then be redeemed for free drinks at the casinos or a hotel room and other things. So essentially, if they succeed in growing this digital casino business, it will heavily incentivize people to also then visit the physical casinos, which will then contribute even more cash flow to the company. So all of this combined together, I expect to roughly double the company's free cash flow already in the coming years. So very significant growth, and the company could supercharge its growth if it wanted to by selling some of its real estate to buy back shares while the stock is heavily discounted. And so now we come to the next topic, which is that of real estate. Caesars has sold many of its assets via sale and leaseback transactions to some REITs over the past years. As an example, Vici Properties owns many properties that are operated by Caesars. However, still today, the company earns about 75% of its EBITDA from owned properties. So these are properties that are on its own balance sheet that's not leasing. I'll put a table on the screen where you'll see all the properties that they own today, and you'll see there are 6 major casinos on the Las Vegas Strip. This includes Paris, Flamingo, Planet Hollywood, and some others, and then it also owns 16 major regional casinos. The exact value of these properties is tough to estimate because it would depend on the initial cap rate, on the lease terms, the current profitability of the assets, and the starting rent coverage ratio. So it's tough to estimate, but many analysts have argued that the value of the real estate is roughly equal to the current enterprise value of the company. The reason why these casinos are so valuable is because this space has greatly institutionalized over the past decade, and cap rates have compressed as a result of it. And this is very evident if you look at the Blackstone's acquisition of the Bellagio in the 5% cap range. I think it was 5.25%. Then Vici Properties also acquired the Venetian in Las Vegas. I think it was 6.25%. These are relatively low cap rate for such specialized assets, and it's well reflected of how this space has become more institutionalized. It has become its own asset type, and investors like it because leases are very long. They typically include CPI-based rent escalations. The tenant is responsible for all the property expenses. These are really well-built properties. They're really trophy-like Class A properties, which are under the net lease structure, and so it can be very attractive for long-term oriented investors. And so I think that this has very significantly bumped up the value of the assets of Caesars, but this has so far been underestimated or at least underappreciated by its investors, who typically are not real estate focused. We think that Caesars could sell a significant portion of its real estate at a roughly 7% cap rate, so a bit higher than the Venetian, the Bellagio, which are true trophy assets. These assets are not worth quite that much, but if it sold its properties at a 7% cap rate with a starting rent coverage ratio of about 2 times, we think that it could recoup most of its enterprise value there. Then, of course, after that, it will have some lease obligations, so its profitability will come down somewhat. However, this will free up a ton of capital to pay off debt, to buy back shares. And if you did all of that, it would very significantly boost the free cash flow on the per share basis of the company. Okay, so now we come to the valuation, and as I mentioned earlier, we estimate that its real estate is worth more or less the current enterprise value of the company, which essentially means that you're getting the casino business for free, or you're at least not paying much for it. And this is very interesting because it's generating a lot of cash flow. There is the founder of One Main Capital, which is a hedge fund that I highly respect and follow closely. Its investor letters and any material it's putting out to investors. They estimate that the company could be in a position to generate about $9 of free cash flow already in a few years from now. And yet, today it's trading at around $40 per share. So that's pricing it at 4 or 5 times its free cash flow, which is a truly exceptionally low multiple for a company that's a leader in its space. It's a space that's growing. It's able to grow its cash flow at a positive rate. The management has an exceptional track record. They have a bit of leverage, but they are not over leveraged. I'll come back to this topic a bit later, but yeah, we just think that the valuation is ultra low here, and if they can execute the plan and now grow this digital gaming business, which by the way, some of those are priced at very high multiple in today's market, if they can now achieve this $500 million of EBITDA target that they've set for the near term, they sell some of their properties to get some equity to pay off debt and buy back shares, and they finalize the latest growth projects, so their capex come down and they start generating cash flow. If all of that works out well, I think that there's a good likelihood that the share price of the company could double already in the coming years. And I'm not alone to think so, because Carl Icahn, who's a legendary investor with a very good track record, recently invested in the company, and he didn't post much about it, but he essentially said that he likes the business, he thinks it's undervalued, and he also likes the management, so he's not planning any activist campaign against it. Finally, even the insiders of the company have been buying millions worth of the stock over the past year, and they've also been very vocal about how it's undervalued. As an example, they recently said, "You shouldn't be surprised if you see us become a buyer of the stock as we get to that inflection point." And then they continue by explaining that they expect their cash flow to grow up significantly, and this will then allow them to free up some of this cash flow for buybacks if the stock remains so heavily discounted. But naturally, you don't get this type of reward potential without taking some risks, and the main risks here is that Caesars is essentially a leverage play on the economy, because casinos and entertainment does rely on discretionary spending. We may be approaching the end of the cycle. They have quite a bit of leverage, and so that's really what's keeping a lot of investors away from the stock. However, how I see it is that the stock has already dropped by 60% in anticipation of a recession. So I think that we have good margin of safety here as long as you're long-term oriented. Of course, I cannot predict how the market will react to a recession. Maybe this will send the share price even a lot lower than today. But I think that if you're long-term oriented, today's starting valuation is already very attractive. And if you look now 5-10 years out, sure, there will be some bumps along the way, but I would expect the company to do quite well even if we went through a temporary recession. Also, while the leverage is a bit high, I agree, it's not as bad as it may seem because they own so much real estate. They also have no debt maturities for the next 3 years, so they have ample time now to sell some of that real estate to pay off debt. Already by the end of this year, they expect their debt to EBITDA to be down below 4 times. That's still a bit high for my comfort level, but they're working it down, and there's really no major solvency issue in the near term. Ultimately, we think that the risk reward is very attractive, and this is arguably the best play to buy casino real estate at a discount today, especially given that Vici Properties has performed so well in recent years. That's been our only casino investment so far, but now we are also invested in Caesars, which is the biggest tenant of Vici. By the way, if you want to access our full REIT portfolio to maximize your gains in this recovery, you can join us for a 2-week free trial at High Yield Landlord. It will be the first link in the description of this video. It will give you immediate access to my full portfolio and all our trade alerts in real time, and you won't be charged anything for the first 14 days. Then the second REIT in which we invested recently is called Sila Realty Trust, ticker symbol SILA. This is a new listing. It just came public recently, and it's a net lease REIT that specializes mostly in healthcare properties like medical office buildings. We got the chance to invest in it before it gained any attention. I couldn't even see a single video on it on YouTube or article on Seeking Alpha. Back then it traded about $22 per share. That was way too cheap. But even today at closer to $25, $26 per share, I still think that it remains heavily discounted, and here's why. I think that it's one of just a few REITs that have the potential to deliver high yield, high growth, and upside in the coming years. Its dividend yield is high at 6.4%, it's paid on a monthly basis, and sustainable with a low 70% payout ratio. Typically, such high yielders have relatively poor growth prospects, but we think that Sila is an exception, and we think that it should be in a position to grow its FFO on a per share basis by 6 to 8% in the coming years. And how it's going to achieve that is that, first of all, most of its properties are under long-term triple net leases with over 8 years left on them. They enjoy about 2% average annual rent escalations. The tenants are responsible for all property expenses, so this falls straight to the bottom line. Then they retain about 30% of their cash flow. As they reinvest this, they're able to also grow by 1 to 2% per year. So that brings your annual growth rate on a leverage basis about 4 to 5%. And now comes the kicker, which is interesting and I think has been, underappreciated by the market, is that the company is under-leveraged today. Its debt to EBITDA is only 3 times, but many of its peers are closer to 5 to 6 times. And we think that the company is going to bring its leverage now up closer to its peer averages, and this will significantly expand its cash flow and dividend in the coming years because, now interest rates are coming down very aggressively. We think that the company could take some debt with a 4 to 5% interest rate already in the near term, and yet the cap rates of the properties that it's targeting are closer to 8%. So that's a very big 300 to 400 basis point spread that it can earn on new acquisitions, and it could expand its portfolio size by about 20% by simply bringing its leverage in line with its peer group. And we expect this to significantly expand its cash flow. And so you put all of this together, the rent escalations, the reinvestment of the retained cash flow, and the expansion of leverage, and the company could, realistically grow its cash flow annually at 5 to 10%. The more aggressive they are, the faster the growth rate. But I think that most likely we're going to be between 5 to 10%, perhaps closer to, 7%. I think is quite realistic for the company. And that's truly exceptional for such a high yielder. And I think that as they pull this off and prove to the market that they can grow at such a rapid pace, the market will reward it with a higher valuation multiple. Today it's priced at just around 11 times FFO. As it reprices closer to 14 to 15 times, it's going to unlock another 30-ish% upside from here. And so all in all here, you're getting high yield, rapid growth prospects, some upside. The company is not heavily leveraged, so the risk profile is also quite interesting, especially considering that these are recession-proof healthcare properties. And so that makes it a very attractive investment for our portfolio at High Yield Landlord. We got to buy it when the yield was actually still above 7%, which was truly exceptional. But even today, I think that remains very attractive. And we are at the moment working on securing an exclusive interview of the CEO for High Yield Landlord as well. So again, if you're interested in that type of content, make sure to sign up for the 2-week free trial. Otherwise, once more, if you could please click the like button, that will help me a lot to keep producing this type of content for you. There are some other REITs in which we have recently invested, and I'm working on more content for you. Thanks so much again, and see you at my next one. Bye-bye.